Looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone, welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Now we have this first question from Mary, and she asks, I know bonds usually pay higher long-term rates than short-term rates. So why are the short-term CDs paying more than long-term CDs? It doesn't make sense to me. All right, that's a great question, Mary. This confuses a lot of people because it seems backwards. And you're absolutely right to question it. The situation we're seeing today with CDs is actually quite unusual from a historical perspective. Short-term interest rates are controlled by the Federal Reserve. When they raise or lower the federal funds rate, short-term rates across the economy move in tandem. Long-term rates, however, are set by the markets, by supply and demand for long-term bonds and the market's expectations for future growth and inflation. So this is a crucial distinction that explains much of what you're observing. CDs are directly tied to short-term borrowing from the Fed. Banks can borrow cheaply from the Federal Reserve, especially now that rates have been coming down from their recent peaks. So they don't need to pay you high long-term CD rates to attract your deposits. They simply don't need your money locked up for 5 or 10 years when they can access funding more flexibly or more flexibility and often more cheaply through other channels. Instead, they offer these teaser rates on short-term CDs, 6 months, 12 months, 18 months. They're hoping that you'll let those CDs auto-renew at lower rates later after the Fed has cut rates further. You know, it's a bit of a bait and switch, frankly. Now, the banks are betting on a declining rate environment, and they're structuring their offers accordingly to maximize their profit margins while minimizing their long-term commitments to depositors. Now, what's happening in the broader market is that investors expect rates to come down over time. So when you lock in a long-term CD or a bond, you're essentially locking in what the market thinks rates will average over the entire period, not what they are today. So if everyone expects rates to drop, those longer-term instruments will reflect those lower anticipated future rates right now. Now remember, a 5% CD for 6 months, it's really only paying about 2.5% on an annualized basis if you hold it for that period. So the math matters here, and it's easy to be, misled by advertised rates that don't tell the whole story. You need to calculate the actual return you'll receive based on how long you're actually committing your money. That's why CDs can be they're fine for short-term goals. If you're saving to buy a car in a new year, or if you need to pay college tuition next semester, or if you're building an emergency fund that needs to remain liquid and absolutely safe. But they're generally not ideal for generating consistent long-term retirement income. They're too unpredictable, and they don't offer the kind of stability and growth potential you need to combat inflation over a 20 or 30-year retirement. Now, for retirees, I typically recommend building a more diversified income strategy. Now, this might include a ladder of high-quality bonds, dividend-paying stocks from established companies with long track records, or perhaps a combination of both that provides regular income while also offering some potential for growth. The goal is to create reliable cash flow that can sustain your lifestyle while also maintaining purchasing power as prices rise over time. Now, that's something CDs alone simply can't deliver in the current environment. Great question. Thank you. If you would like to send in your question, you can do so by emailing that question to poollocke@poollocke.com. So we'll move right along to our second question. This question comes from Jack, and he says, I have a pension, but it doesn't have a cost of living increase like Social Security does. What can I do to protect myself against inflation? So Jack, that's a concern for a lot of pension recipients. And it's a smart question to ask. Now, it's nice that you have a pension in the first place, but you're thinking ahead, which is exactly what you need to do to protect yourself over a potentially long retirement. So first, I want to point out that even Social Security doesn't always provide a true inflation hedge. Yes, there's a cost of living adjustment most years, but the COLA. But Medicare premiums often rise faster than the COLA. And those premiums are automatically deducted from your Social Security check. So even though your gross Social Security benefit might go up 3%, your net benefit after Medicare might only go up 1% or less. It's important to understand this reality when planning your retirement income strategy. Most pensions don't adjust for inflation at all. You get the same payment every month for the rest of your life, whether that's 10 years or 40 years. Now, that's wonderful for predictability, but it's terrible for maintaining purchasing power over a long time period. A $3,000 monthly pension today might feel comfortable, but in 20 years, even with a modest 3% annual inflation, that same $3,000 will only be about what $1,650 buys today. That's a 50% reduction in your standard of living. So if your pension and Social Security make up most of your income, here's the key: you can't spend it all. You need to live on less than you receive and reinvest part of it to create future income growth. Think of it as paying your future self. This requires discipline, especially early in retirement when you're healthy and want to enjoy your newfound freedom. But it's essential for long-term financial security. If you also have retirement accounts, IRAs, 401ks, brokerage accounts, you may need to take less from them early in retirement, particularly in your first decade after leaving work. Let those accounts grow and generate increasing income over time. Eventually, that growing income stream will help offset inflation's impact on your pension and Social Security. This is where patience really pays off. That way, your assets do double duty. They're providing some income now, but they're also growing to provide more income later when inflation has eroded the value of your fixed pension. You're essentially building an inflation hedge into your overall retirement plan. And if you structure those retirement accounts properly, investing in quality dividend-paying stocks, bond funds, REITs, business development companies, you can generate income while preserving your principal. You're not forced to sell shares in a down market just to cover your living expenses. You're collecting interest and dividends regardless of what the market does on any given day. Now, this approach gives you both income and the potential for that income to grow over time as companies increase their dividends, which many quality firms do year after year. Two great questions. As always, if you would like to send in your question, love to answer it. Email that question to Poole Locke at PooleLocke.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I will see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me